a huge amount of shares are being shorted on the SLV, and what that does is it keeps, puts downward pressure on the price.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on Friday, September 23rd. And quite fortunate, I'm joined by my good friend Rob Kientz of GoldSilverPros down here in Mexico with me. And nice to get to do a live recording as we dig into the latest silver market activity. And certainly been an interesting time in the markets. As of Friday, we saw another decent sell-off in both gold and silver. Sell-off in a lot of the markets this week. So excited to have you here, Rob. First of all, welcome to Mexico. How's everything going so far here?
I mean, how can you go wrong? You've got palm trees in the background, you got warm weather and beaches. I can't really complain.
Well, it's good to have you here. And something other people have been complaining about, and perhaps understandably so, we've seen silver go from 26 bucks down below 19 as we're recording today. And perhaps we could get your thoughts on that price movement and what you're taking away from that.
So I think there's a lot of selling pressure in the market in general. It's like a liquidity crisis or a run to liquidity in the market, and so everything gets sold off. I think before we saw gold and silver sell off, the miners are actually doing very well. They were up 30 or 40% this year in the first couple of months, and then they started selling off with everything else. And I think it's just negative pressure on the markets. Some people get frustrated when you see inflation and things like that, and you don't see the metals pop. But I always go back to what the trades are. You have this massive amount of people shorting SLV, and SLV, I look at that as like a market signal. It's passive investment into a fund to simulate silver. And, people trade that much like they would trade any mutual fund or stock. That's not necessarily buying or selling of the actual precious metal underlying it. It's just shares. And it's people's opinion on what that market is. And I think for SLV in particular, they've got something like, is it 60,000 dropped? But look, 60 million something. A huge amount of shares are being shorted on the SLV. And what that does is it keeps, puts downward pressure on the price. And I think from the COMEX, people know from my show, we talk about that all the time. There's just a lot of derivative selling, and it really has nothing to do with physical. And I know all of this frustrates people, but when you look at a derivative market and the price is moving one direction, but you look at a physical market and it's obvious that people want physical, they're buying it retail and they're buying it industrially. At least we see the metals coming out of ETFs and exchanges, so we know that people actually want it. It's a frustrating dynamic because people are like, wait a minute, people are absorbing all of this silver that we're producing, and then some that's sitting in these various warehouses. Why is the price not moving up? And the only thing that I can say is, well, it's the people trading the paper derivatives, and there will be that disconnect until there's a point in time in which there's no silver left for the market to actually absorb and use physically. And then at some point in time, traders going to have to go back and say, okay, why are we still shorting this? You can always short it while there's metal there. It's really hard to short it when there's not a whole lot of metal there. And I think we're getting to a point at which we're not going to have as much metal as we're used to having. And at some point, something's got to break, between the two.
Well, in terms of just the driver behind why so many people are shorting it, obviously, I think there's a degree to which the Federal Reserve, which we saw another 75 basis point hike this week.
Yeah.
We also had Vince Lancy on the show, a really smart silver trader, a couple of weeks ago. He mentioned the banks have been giving a recommendation to a lot of the commodity trading advisors that selling copper, selling silver as a hedge to dropping stock portfolios has impacted that.
Yeah.
Any thoughts on, before we get back into the physical, just in terms of what is incentivizing people to be selling so much? Any thoughts on those two factors or anything else that might be playing in there?
Yeah, there's a lot that goes into people's opinion on the precious metals. And what happens in the resource industry, especially, you have banks and you have big ratings agencies and people like that write about the markets, and they can influence the position one way or another. It comes out on these reports that money managers get, that people are interested in the market get, that big whales who have been playing the market either from the equity side or the derivative side get. So if somebody writes something and says, you know what, silver price is not going up, it tends to be self-reinforcing, because a lot of those come out as recommendations from a broker or a banker or somebody like that. And so it's easy for the momentum to carry forward a direction something's going, especially when the market's talking about it. But again, when you're looking at what they're talking about prices and markets derived from paper, which has nothing to do with physical. So, like I said, I always go back to the physical. If the physical is in demand, and it is, and we're running shortages, which we do, eventually those guys that are riding on the market need to catch up with the physical side of the story. And that's why we do it Gold Silver Pros. And we're certainly not the only ones, but we like to point out what the physical characteristics are of the market. If people are selling SLV or they're selling other silver-based interests to stay in the stock market, that makes sense because the managed money brokers are always going to want you to buy those types of investment because they make money off of them. Where if you buy physical gold and silver, there's not really, a big spread on that. There's not those tend to be really tight markets. So the money managers don't want to deal in physical, so they don't want to deal with that type of product. And so they may have gotten them into SLV or something else, and then they're like, sell to keep your other stocks because it's where they're going to make their money. One last point I wanted to point out, my ex-wife, when she went to switch her 401k into another qualified account, she went to work for another employer. She went to her bank, and out of her bank, she said, I want to be in this, this, and this. And the bank ended up putting her in things that she didn't want to be in. And there was an investigation regarding that. And when it all came out, the guy said, well, because it made more money. And who did it make money for? It made more money for the bank. So they had moved her money into something that was a little bit more positive for the bank because they were, watching and taking care of her money. And a lot of times advisors will move you into things that are better for them, whether it's the commission they'll get or they feel as though it's less risky. But a lot of advisors really aren't market experts in the precious metals or the commodities. So I could understand that definitely happening. I would tend to pay attention to people that really understand these markets, before selling a position, even in SLV.
Well, that's why we have you here today, Rob. Fortunately, now in terms of wondering what the downside is, I was watching a video from SRS Rocco, Steve St. Angelo today, which was very well done. And he had a slide up there that we will post in here. He was showing that we're close to the cost of production. If you look at cash costs, he had it around $20 for the average primary silver miner. Now, again, that's not necessarily a straightforward thing in the silver world because we have about 65-70% of the silver comes from copper, lead, zinc, gold miners who just have it and they're going to sell it. But his slide showed that generally for the past couple of years, the price has not gone too far or stayed too far below the cost of production. So do you think that will provide a floor going forward, or do you see it going much lower than that, or where do you see the paper pressure, which still is what determines the price? How far do you think we could see the bottom?
Well, I studied gold and silver and their relation, how their price is determined a few years ago, and I used some of Steve's work. Actually, he did an excellent report on what drives the price of gold, and I used that as a starting point and kind of did my own research on both gold and silver. And gold and silver, the spot prices often are partially a reflection of what it costs to get it out of the ground. So, for example, in gold, it was always the 2 or 3 largest miners. You would average out their cost of getting it out of the ground that they publish in their financial reports, and that would be the floor for gold. And then any additional value you had for gold was really a measure of like fear factor or demand from a passive investment. So you could look at GLD as a proxy. So let's say the mining costs were $12.50. Lots of people are piling into GLD. All of a sudden, that gold price could go up to $1,800, $1,900, or even $2,000. And so there is a correlation between these derivative investments in the metals and the spot price on the futures market. It's similar for SLV. But what's different is with silver, because silver is most of it's not coming out of primary silver mines, you can't use those silver mines to determine what the cost should be because most silver comes from other mines. And how do you separate out the cost of mining of silver if it's only 0.1% of your production when you have a big copper plant going? And so silver can sometimes tend to fall below the cost of production of the primary miners. And it's usually when the miners start complaining to the market or they start taking things offline because they cannot afford to produce it anymore, that causes silver to come back into equilibrium. So silver in many cases is a little bit more volatile than gold on either side of that cost line of the all-in sustaining cost to get it out of the ground for the current mine year. Whereas gold, it never really falls below that. because essentially most gold does come from primary mines. And so it's easier to say, okay, all this gold's coming out of primary mines. We don't want it to go below 1250, 1300. We're not going to make money because we know the gold miners are going to stop mining it. It's an easier case to make that gold doesn't fluctuate as much above and below that all-in sustaining cost of largest miners. Whereas in silver, it does. And so where silver could go, I mean, it could fall down to 10, 11 bucks an ounce. We certainly saw that a couple of years ago, and then the pandemic sort of rescued it, and people, bid up the price of silver because there was worries about supplies. And I'll also point out one thing that I find very interesting during the shutdowns, and even when a lot of the refiners were basically going offline and not minting gold and silver, we had the biggest supply deficit. Well, it makes sense. The refiner shut down. So I think that year in 2020, we were 248 million ounces short of silver, according to Silver Institute. So there are supply chain considerations also that kind of play into there. And silver is very particular with that because we use more than we mine every year. Whereas gold, we have more above ground stocks. We can dip into those at a higher price. And so that's why you see a lot more volatility in silver. And that's why silver is a little bit harder to call on a bottom, because you can look on a technical chart and you can see sentiment. You can know what the primary silver miners need to get it out of the ground. That doesn't mean you can't short the hell out of it below that, because nobody really knows what the price is to get silver out of the ground all conclusive. Nobody's, has that information. So it has a little bit more space to fluctuate up and down. But in general, when silver price or gold price goes below the cost of production, they tend to not stay there for very long. They'll boomerang back up at some point.
Well, it will be interesting to see how that happens. I mean, it's certainly an unusual era of financial history where even into what I guess we're not supposed to call a recession, but you have the Fed continuing to hike and calling for more hikes later this year. Sounds like they're expecting another 75 basis points in November, so we will see how that goes. Mm-hmm. Although, Rob, a question that I've been thinking about a lot lately, one of the primary reasons why we've looked to silver is as an inflation hedge. And now we have the inflation is certainly here in the 30s% in Germany, which is something that I'm sure they're taking notice of there. Is it still fair to call silver an inflation hedge, or what would you say there and how we should be looking at that?
Before silver became the most important single mineral in the world, or the most important single thing in the world, outside maybe of the sun, air, and water, to human existence, I would say yes. But I would say there's an incentive now to make sure that we have free-flowing silver, because we could not have this conversation and put this out on the internet if we didn't have silver, because everything that we see sitting here uses silver. Silver's in medical, it's in military applications, it's in computers, it's in everything. So there's an incentive right now to make sure there's free-flowing silver. So when I go back and look at what happened during Silver Squeeze, where the CFTC and the markets with CME Group managing those markets decided basically to say $30 silver may be their upper circuit breaker, and that they came out and said we were doing things in the market to make sure that we have that free-flowing silver under 30, which they admitted to. I mean, it's public information. I looked at that as, hey, they're realizing that we need to keep the spice flowing, and the spice in this case is silver. They need it. Without it, everybody's in trouble, because we can't build our economies without it. You can't build telecommunications. You can't build military applications. You can't have a tech sector without silver. You can't build solar panels and EV. So a lot of the things that they want to build and institute that are coming out in government programs, that are coming out in all these ESG initiatives, need a tremendous amount of silver. So to allow silver to run really high and change the dynamics of that market is going to affect ESG, the future of renewable energy, the future of telecommunications, the future of a lot of things. And because silver is not so easily substituted, I believe there is a tremendous incentive worth billions and maybe even trillions of dollars and potential lost economic output to keep that silver flowing. It's keep the spice flowing. It's the Dune movie. They got to keep the spice flowing to keep, because without the spice, all the houses in Dune will lost their power. Well, without the silver, the economy shut down and stopped, and we have to go back to living a much different lifestyle. And a lot of the things that the green movement and the ESG movement wants will never come to fruition without silver. Tesla can't build cars without it. So I think that silver has now diverged from gold in that it's not acting primarily as a monetary asset. I think it's acting primarily as a commodity in which the world desperately needs. And so I think there are incentives there on the markets to make sure you have that spice flowing. And I think that's what we're seeing right now.
Which leaves some interesting dynamics because, as you pointed out, Silver Institute numbers showing deficits the last couple of years.
Mm-hmm.
And also at $19 silver, I don't think there's a lot of folks, in a rush to go start a massive new silver operation. So,
Mm-hmm.
not bringing new supply online. With all that said, what is a reasonable expectation for silver going forward? Is it a matter of just needing to see those inventories drained in some sort of crisis, or seeing some sort of crisis in the banking sector? Again, we have mortgage, which is again in your area of expertise as well, slowing down. So conditions for something like 2008 seemingly in place, but what does it take for silver to move from here?
I do think that there's still a component of people that see it as a monetary asset, and I do think that it's sort of the poor man's gold. So if you get into a situation of dire economic consequence, where you have deeper sell-offs in the stock market, bond rates continue to go up. I mean, we're at 4%, over 4% on the 2-year treasury for the first time since 2007, before the last crisis. So obviously the economic situation around the world is not going, it's not the best, and we're having pressures. And if we continue, is that an understatement?
I mean, that's phrasing kindly.
I'm being very kind here, but as those pressures increase, yes, people are going to go to stuff that are safe havens. If you look at dollar milkshake theory, and the reason the DXY and the dollar and the DXY is going up so much is because what Brent Johnson put out there is true. People are flying to the dollar. Why? Because the dollar's used in settlement for goods and services, and it's the reserve currency. And that will happen until it's not. With all the de-dollarization, eventually that will occur. But right now, the dollar is absorbing a lot of it. A lot of the what people are going to remain liquid. They're not necessarily going to gold and silver. That is still there. I don't know that people are going into bonds with rising interest rates, but they could be. I mean, if you get into a bond, the interest rate rises on a bond tomorrow, the value of your bond has to fall because you got a lower interest rate. So I'm at 3.5 and now it goes to 4.5. I think the 2 years are like 4.2, but it goes up. And that means the value of your 3.5 has to go down to get somebody to entice them to buy it in the secondary market because their yield's lower. So I don't see where people are going to go this time in a rising bond rate environment with crashing stocks. You have earnings coming down on companies. Where are people going to go? And I think what's happening is when the realization comes for people to get in precious metals, it tends to come all at once. It tends to come when CNBC starts talking about it, and they never talk about gold and silver really. I mean, they'll throw the price up there, but it's all stocks and bonds and stuff and Bitcoin. So we tend to see this waterfall, drop off in the other markets, and then you see people come into gold and silver. And I think when that, David Morgan's always said, when that marginal demand for silver as a monetary asset or as a fear asset or as money comes into play, you'll see the price spike. What's different this time, and you mentioned it, was the declining inventories. There's going to be less silver above ground to absorb the impact of people wanting more physical. And I think the rest of the market knows it. And I think that's why they're grabbing the physical. And the reason you're seeing physical come out of like SLV, even at a time when the share price is dropping, which is counterintuitive, is because I think that there are people shorting SLV that think that silver is going down. So it's a popular vehicle, they're going to short it. And authorized participants are sitting there going, okay, we'll take the silver off the market. I'll redeem my share. There you go. Thank you very much. And they destroy the shares, which should put upward price on the pressure because less shares, but it doesn't. And so it's really complicated. But if you understand the markets, you understand where we are, and you understand we're not too far from some sort of Minsky moment in the economy, and therefore where gold and silver are going to do, pretty well. But I think it happens when there's this broad realization. And I don't think that people follow gold and silver every day. The average person doesn't follow it every day. So they're going to come in when they come in. The sharp, what I call the sharps, using a gambling term, have already been in. They're liquidated. You can see that on all the markets. They're taking what they can. When people come in from our network, come and order $3 million from Mark Silver, they're doing that because, hey, I need a lot of gold and silver, and I'm going to go in and I'm going to buy a big chunk of it. Of course, we had that billionaire heiress that did 50 million out of Texas. So I think the sharps and the smart money are in. The rest of the money hadn't come in yet, but it will. And when it does, we'll see the same dynamics we saw probably in 2009, 2011 to some degree, and we'll have to see how bad the economic condition is to see where gold and silver will end up. I'm not going to call a price on there because I don't know how bad it's going to get, but I certainly think that the fundamentals are setting up for something pretty bad in the economy. And when that happens, I think gold and silver are going to have their heyday like they typically do, because I don't think you're going to be able to stop people from going and trying to find value.
So is that when we see Exeter's pyramid, which I might add, Rob Kientz, you show up in some of the top 2 or 3 Google rankings. If you look at Exeter's pyramid, which you've written about and talked about, of just this money have to go somewhere and flows to the bottom of that pyramid.
Yeah, the Exors pyramid was done by Exter was a central banker, and he also, after being a central banker, was an advisor to Paul Volcker, who was the central banker of the Fed at the time, the chairman at the Fed at the time. And he basically went to Paul Volcker and he's like, gold and silver are the ultimate hedge against the financial system. And Volcker understood that. And he developed Exter's pyramid as a way to tell the central bankers how the system works and where the value really is. And it just so happens I redid Exter's pyramid and published it on Seeking Alpha and added some things in it and reorganized it from more of an investor's or an individual's perspective. But the thing that's the same between my version and Exter's version is when the system at the top collapses, all these derivatives start to collapse in on itself, the value flows down. Whatever money is left in that system that hasn't been destroyed is going to flow down to precious metals. Now, it may also flow to things like businesses and other things that'll get valued up. But the ultimate hedge, the ultimate safety net in an economic system has always been gold and silver. And until we go through a major financial crisis and we don't see people respond to gold and silver like that, then I still assume that they are, because I don't know where you go. I'm not going to want to buy stocks. I'm not going to want to buy real estate. I may not want to invest in somebody's failing business. I may not want to go back to school. Is it going to be worthwhile if there are no jobs? Am I going to want to go buy a rising yield bond that's going to be worth less as soon as I buy it? It's like driving a car off the lot. Your car's worth less. That's what the bonds are right now. It's like driving a car off the lot and losing money. Who the hell's going to do that? I mean, where else are you going to go, honestly? I go into real things, and I think gold and silver have always been that hedge. So I still think Exter's pyramid applies.
Well, that's fair enough. And one place where conceivably people could go, I'd be curious to get your comment on this that I have pulled up here. A lot of people have seen this, but we have not talked about this on the air. Moscow World Standard, with several of the news sources, as Ronan Manley in his typical great reporting, news sources using the phrasing to destroy LBMA pricing. And we'll see, perhaps a little early to tell what will be the ultimate impact, but did you have any thoughts on the Moscow World Exchange?
So this is probably the rest of the world realizing that the London and COMEX markets, not only do you not have true price discovery, but I believe the markets are used to funnel gold and silver to entities that market thinks needs it. Because if you look at the settlement procedures and the way it's done, first of all, it's very difficult to do. Secondly, it's put into a channel of only a few billion banks that can help you get there. And we know from Rafi's experience going through IB didn't do him any good. And so it's a controlled market where the physical squeezes out in this little pipeline that's controlled by very few people, and a very esoteric process, which is not meant for the people. We illustrated that. And I think the rest of the world is like, screw this, we need free markets. I mean, we look at the Chinese market right now. Chinese gold, as the time of reporting this, is $43 higher than the gold price in the Western market. Why in the hell is that true if LBMA and COMEX are representing the whole market? It's because they're playing bullshit games on their end, and the Chinese are tired of it. So they hired JP Morgan to come in and say, we've had the Shanghai Gold Exchange and the rest of this market. Let's go build it out for the rest of the commodities. Let's go blow this thing out. So now the Chinese are blowing it out, and the commodities market's forming their own. So you got China doing it. You have Russia doing it. India's announced that they're doing it. The French have announced that they're doing it. Dubai has announced that they're doing it. Everybody's standing up their own markets. And the reason they're doing that is because the gold and silver markets for too long have been ring fenced, and controlled by a small set of entities. Who are those entities? According to the Office of the Comptroller of the Currency Report, and according to positioning by CFTC and the COT report, we know that there are 4 major banks that control those markets for the rest of the world. And we know them because they're in the OCC report. They're named as Bank of America, Citigroup, Goldman Sachs, and JP Morgan. Those banks control the pricing and the flow of the precious metals around the world. The world is tired of it, and they're moving on to a more free market. I applaud the rest of the world for doing this. Because why? If Shanghai comes out, France comes out, Dubai comes out, Moscow comes out, India comes out, and they're free trading, and by the way, they have more physical settlement, and those prices are different, I think they have a legitimate case to go back to the LBMA and COMEX and say, we didn't see this on your market. What were you guys doing? And I think that's a fair question. But the only way you can ask that question is to establish these other markets and let them trade. And I think that's what they're doing. They're going to establish markets, let them trade, and let the trade and the market speak for itself. And so what's really happening, if you look at it, is the rest of the world saying, we want free markets. We're going to go build them. And LB COMEX, good luck with you guys. You can do whatever you want to do, but we're going to let the markets trade. And I think that's one of the things in which you could expect to see more rational thought about what the market is in gold and silver. And that'll be another catalyst for getting the control out of the hands of the guys that, you know, basically I'll call the bullion bank mafia, which has been running it for God knows how long.
Well, as we found out in the Deutsche Bank trader transcripts from their case in 2016, they also referred to themselves as the Silver Mafia.
That's
so
right.
not complete conspiracy theory, actually conspiracy fact, because since they were discussing it with UBS and a few of the other banks, I guess that does define a conspiracy.
It
So
does.
either case, good to see just more available options in terms of metal trading. I think that's always a good thing from a free market perspective, and always a good thing to have you on the show, Rob. So I appreciate you joining me. And real quick before you wrap up, as you can see, I have my First Majestic silver shirt on. And Rob, I think you saw that they hit 19.35 grams per ton gold as they were drilling in Jarrett Canyon, where they are continuing to drill, which I know they're excited about. It was nice to see them at the Silver Symposium, especially because they're ramping up production, which will also bring down their cost of production, which they are targeting for the fourth quarter. So congratulations to First Majestic, and thank you for being a part of bringing this show to folks every day. And with that said, Rob, we can find you at
GoldSilverPros.com, and stay tuned next week. We're going to have a former deputy commissioner from the CFTC tell us some of the issues that the CFTC has had with regulating markets. We had this interview at Silver Symposium. We'll be bringing it to you on the channel. I was lucky enough to interview the gentleman and ask him a bunch of auditor type questions. And to his credit, he answered them. And I think it's going to shed a lot of light, Chris, on what we just talked about in this last segment and why that stuff can go on. It's really going to surprise a lot of people. So stay tuned to our channel next week. We'll have that. And real quick word on First Majestic. I was speaking to our good friend Dave Kranzler on that Jarrett Canyon acquisition. And I said, you know what? They had to pay a pretty penny for that, but I know why they did, because they wanted some gold. And Dave pointed out, not only do they have gold at Jarrett Canyon with the type of results you're seeing, but they got an enclave. And that enclave is the only one really in sort of the Southwest area that can process certain types of gold. So not only are they going to get a lot of gold to add to their bottom line, they've got a device which everybody else is going to come to. So now all of a sudden they're going to get those revenues too. So I think the Jarrett Canyon acquisition by First Majestic is a pretty damn good one. It makes them more broad as a company and gives them all sorts of options. And kudos to that team. I mean, First Majestic is one of the class acts in the mining space, led by a great guy, which everybody in our field really loves. And, you know, I'm rooting for them. I think they're a great company.
Well, I certainly agree with that, and appreciate everything they've stood for and done in the silver industry. And Rob, great to hear it. First the Perth Mint, now the CFTC. Who knows what you'll go after next? But that said, going to wrap up for today. But hope you're all having a great day out there. Thanks as always for tuning in, and we will see you again tomorrow.